G'day folks, welcome back to the weekend update for February 20. Since the middle of last year we've had a very strong run on the market, particularly in the small cap sector, and I called what I thought was a correction based on the signals that I could see in the middle of January. In the end that correction didn't follow through, but I'm seeing even more significant signals now than I did back in January, and I think it's prudent that we observe those signals and that we do reduce our exposure. So this weekend's weekly video is really about giving you some insight into why I'm making that call at the moment, and to encourage you to start to wind back your exposure, particularly in the small cap sector of the market. So let's have a look at the charts. There's our important information regarding licensing and the fact that this video is general advice only. So we'll have a look at the summary of the market. The S&P 500 is still rising, but it is hugely extended. You can see the bullish percent index is more overbought than at any time that I can identify in the last 3 years. Which is as far back as I can go on the data, but certainly we've seen nothing like what has happened in the recent period over the last 3 or 4 months, and that's really purely down to the quantitative easing in the United States. If the US market were to retrace from here, I think 1280 is a logical retracement zone, and we'll have a look at the chart and why that would be the case. And we'll take a look at the important US dollar and Treasury bonds as well, which to my mind in the medium term still support a move higher. Now when it comes to the Aussie indexes, the ASX 200 is just broken out of a significant trading range, but frankly it's struggling. I'm not really seeing any great strength there. BHP and Rio, after terrific profit results, are really languishing. The banks have had a great run up, but they're starting to show some signs of running out of puff. We've also got the Small Ordinaries Index. The XSO is struggling. It's formed a triple top and seems unable to break through it at the moment, and my concern is that some technical factors may kick in soon and cause some selling in that sector. Now moving on to commodities, copper is in doubt in the short term, and that's the one that concerns me the most, because if copper does go into a more meaningful decline, then that will drag the general stock market down with it, because copper is seen as such a barometer of economic activity. Precious metals are moving higher. Gold has moved higher, but in particular silver is where I think the best risk-reward opportunity exists in the stock market at the moment. Base metals inventories are rising, which is not a great sign, because when the amount of stockpiled copper and nickel is increasing, then eventually that flows through to the actual commodity price itself, and then of course through to stock prices as well. Oil, I think, is probably based out around the $85 mark, and based on what's happening through the Middle East is heading higher, but in my view is heading higher in the longer term, just based on sheer supply and demand fundamentals. It's just going to put a lot of pressure on the oil price over the next few years. Tin is still in strong uptrend. We had a 2% correction on Friday night, but that's just a little blip in a long-term trend higher. So let's have a look at some charts. We'll start with the 30-year Treasury bond. And as you've seen before, there's a key danger level up here at about 4.85, 4.9%. Once you get above that level, then stock dividends start to look less attractive, given that they have some risk attached to them, by comparison to the perception of risk-free bonds. It's only perception, because you can put your money in bonds and people think that their capital is guaranteed, but over the longer term they are going to lose substantial amounts of capital. So for me to be accepting 4.5 or 5% interest, yet I could lose 20 or 30% of my capital value, over the next year or two is a terrible deal, but a lot of investors don't necessarily see it that way. So that relative attractiveness is not good for stock markets if the 30-year bond interest rates move above 5%. Now the US dollar is in long-term downtrend from 2002. We're basically tracking sideways at the moment in a broad band, but in the medium term, shorter to medium term, that is heading lower in my view. So let's have a look at the S&P 500. And the S&P 500, as you can see, just continues on this amazing run that we've had since August, when Ben Bernanke started talking about quantitative easing. We had a brief correction period from the 5th of November through to the 30th of November. So it was about 3 weeks. It declined around about 5 or 6%, and I think we're certainly overdue for something similar. Now, looking at this technically, there's a couple of different levels we can identify. If we take the retracement from the start of this run here on the 30th of August to the current peak, we get our first retracement level at 1225. Personally, I don't see the circumstances that would have the stock market down at that level. So I'm really working off this more short-term period, and that's from the end of the correction on the 30th of November to the current high. And if we were to pull back to the first retracement level, that would be just around about the 1280 mark, and that would also correspond to the 50-day moving average. So that would be a reasonable pullback for the S&P. It would be around about the same dimension as what we saw here in November, and that would then open the way for the S&P index to head higher. And my next target is really up here around about the 1450 mark, which is quite a bit higher, and that represents about 400 points on the Australian market. Let's have a look at the Aussie index, and you can see we did break out above this level, this 48.20 area, which has been a resistance area. We've moved above that. We've peaked out at about 49.40 during last week. 5,000 or just over is a fairly key level, so we don't have a lot of upside to a fairly significant resistance level. So I'm sure that our market will probably pause and retrace from that 5,000 level. So in our market, we're certainly in a position where there's maybe only 60 points of upside, but potentially 3 or 4 times that in potential pullback on the correction. So from a risk-reward point of view, our market has become a lot less interesting in the near term. Let's look at the Small Ordinaries Index, and you can see here we've now formed a triple top. We've got the first one here in January, the second one on the 9th of February, and where we are now, currently sitting at around the 29.50 area. So unless this can break through and close above 29.60, 29.70, then I think we're in danger of this market correcting back to perhaps this 2800 area. And that would cause a significant change in sentiment towards some of the small caps, at least in the short term. But I hasten to add that this correction that I think we may be about to get should be relatively mild and relatively brief, as in perhaps 2 to 4 weeks. But it has the potential to impact small cap share prices enough that you need to do something about it. So I would really encourage you not to decide to sit through it, because it's likely to set up some great bargains, and you really need to have some cash to take advantage of those, as well as obviously protecting some of the gains that you've made. So we'll have a look at the tin chart from 2009 to 2011. Might be a little bit difficult to see, but Friday night we just had a little bit of a tick down, but there's a very strong uptrend that's taken tin from around $16,000 a tonne to just over $32,000 a tonne, basically in the space of 12 months, or if you come over here, really in the space of about 8 months. So that's an incredibly strong trend, and it wouldn't surprise to see tin pull back a little bit further, and that doesn't really change that equation at all. This is the copper inventory on the London Metals Exchange. You can see that we had this lengthy and very consistent downtrend in the inventories of copper. We've dropped from 560,000 tonnes to about 350, but now we've started moving back up again since early December, and we're now back above 400,000 tonnes in the London Metals Exchange warehouse. And that has to feed through into prices, which in fact it's doing. So it's not so obvious on this 1-year chart. We'll have a look at the copper price chart on Market Analyst, but you can see we've certainly had a little bit of a dip in copper, and it really needs to hold this level. If it was to close very much lower from here, then we could be heading back down to $4 a pound, and that would certainly have a sentiment impact on any of the stocks associated with copper. Looking at nickel, we had a long decline in inventory. We had a base. The stock levels of nickel started moving up higher, but have now started to decline again. So nickel is tracing out a different pattern to that of copper, and as a consequence, the nickel commodity price has continued to push higher, and it's now back above $13 a pound. So nickel, if anything, in the very short term is looking stronger. So let's take a look at some more charts, and we'll have a look at the copper price. So panning back, we've had a very, very strong run with copper. It's still in uptrend, and as long as it remains above this upsloping trend line, which at the moment cuts in at around about $4.25 a pound, then we're still technically in uptrend. But if the price fell from the current level of $4.45 down to $4.25, then it would certainly impact on small cap stocks to a reasonable degree. Let's have a look at the gold chart. And gold also tracking higher. You can see there's a very strong uptrending line through there, and the gold price is still significantly above that trend line. Trend line at the moment cuts in at around about 1,290 US dollars. The gold price is nearly $100 an ounce higher than that. It's also maintaining above the 150-day moving average as well. So gold would appear to me to have bottomed out and heading higher. Could pull back in the short term, maybe to this 1350, 1360 area, but I think gold is heading back to test its highs around about the 1430 mark. Now the really attractive one for me is silver. Silver's done far, far better than gold. Silver was held in this range between $9 and $10 and $20 for quite a period of time. There was some illegal activities by some of the major banks that are currently being prosecuted that was holding that silver price down, and once that was exposed back in August of last year, then the silver price just took off and basically went from under $20 to now being only $32. So we've seen nearly a 70% move higher in silver. We've only had the one pullback in silver that was during January, when precious metals became a little less fashionable, but it's picked up again, and from what I read of the supply and demand dynamics and some of the other factors in the futures market, I think we could be about to see silver move very significantly higher. The all-time highs are back around about the 41, 42 mark, and they were established back in the early 1980s from memory. So I think silver offers a terrific opportunity. Now, case study last week, I talked about the option of buying silver through one of the CFD providers. So if you haven't seen that, then check in on that part of the recording that we made of the study session. We've also got a couple of stock options. We've got CCU as an option. We've also got AYN as an option to actually buy stocks associated with developing silver. But a really interesting company that I think offers a completely different perspective on silver, which I wrote about in the daily alerts this weekend, is a Canadian company listed on the US stock exchange called Silver Wheaton. Their code is SLW, and that's can be traded through CMC Markets under that code. And I've written about it fairly extensively in the alerts, so I won't repeat that here, but just to make the point that the shares of this stock were trading in November of 2008, which is only slightly over 2 years ago, were trading at $3. They're now trading at nearly $40. And it's been a very, very significant trend higher. You can see the moving averages are very supportive of that. We've just gone through a fairly significant correction that retraced a little more than half of that run higher, and now we've started to move higher again. And you can see on Friday night we had a strong move from $36.50 to $39.50. Volume was strong, so I really think SLW is another way to play that silver theme. And as I indicated in the daily alerts, they've got a unique business model that eliminates a lot of the risk of being a miner, but gives them upside to an increasing silver price. So the opportunities this week, I'm not going to say don't do any buying, because individual stocks can always go up during a corrective phase, but you just want to be far more judicious about any stocks that you may want to buy. And overall, reducing exposure I think is prudent. What level you bring it down to is really up to you. I would suggest that you think about getting down to perhaps half, at least as a starting point, and then let's see how we go from there. Now the US markets were higher on Friday night, so I think Monday here should be quite reasonable. So there's no need to panic on this. I think just over the next few days, if you can start to sell off some of the stocks, as I indicated in the alerts, I think there's a certain order and thinking attached to how you do that, but that's all outlined in the alerts. I'm not expecting this correction to be anything other than something relatively mild, but it's still worth taking some action on that. So the silver alternatives that we've got, you can buy on CMC Markets if that's the CFD provider you're using. You can buy the XAG USD, so that's the US dollar price of silver. We've also got the Exchange Traded Fund in Australia, which is ETP MAG. It's not very liquid, but it pretty closely tracks the price of silver, so it's a pretty direct relationship there. We've got some silver developers, and we've also got Silver Wheaton as an opportunity as well. So that's pretty much all I wanted to cover for this video. I think the important thing is in the short term to get your exposure down. It's time for a bit of housekeeping. Capitalise on some profits that you've got. Make sure you've got some cash, because I think we're going to have some wonderful buying opportunities. Quite a few stocks are now a little bit overvalued. My view has not changed that this is going to be a fantastic year of opportunity, but we do need to be very active, and we do need to get out of stocks at certain times and reduce our exposure, and I think we're at that point in time right at the moment. So I will keep you informed through the daily alerts. So that's it. Cheers for now. Speak to you next week. Bye-bye.